Welcome to Let's Talk Investing, a co-production of the Globe and Mail and the Investor Education Fund. I'm Rob Carrick, personal finance columnist at the Globe and Mail, and with me is Malcolm Hamilton. Malcolm is an actuary at Mercer and an expert on pensions and retirement issues. Malcolm and I are going to talk about the pension fund crisis, in quotes there. Malcolm, how bad is the pension situation, broadly speaking, in the country?
Well, pension plans are badly funded, and it's really all of a sudden. They were fine at the start of 2008. But as interest rates dropped, their liabilities went up, and as the stock market dropped, their assets went down, and as a result, they ended 2008 quite badly funded.
So they've got a lot less ammunition, in a way, to, so to speak, to pay for all these obligations. Their current workers, their future workers, their current retirees, and there's a gap between what they need and what they have. That's
right. There's a significant funding shortfall, and it needs to be made up.
Now let's talk about the kinds of pensions, because not every pension plan out there is in trouble. Let's talk about the private sector versus the public sector, the government workers. How are their pensions doing versus the individual companies? Okay,
the distinction I'd make is they're all badly funded. The public sector is badly funded, private sector is badly funded. They're all going to have issues with affordability. The big difference is if you're in the public sector, you don't need to worry about your pension because the employer is going to keep going. Governments aren't going to go out of business. Hospitals and schools aren't going to shut down. So the employer is going to be there. They will have to make up these deficiencies in the fullness of time. It will make their pension plans disappointingly expensive, but you're not going to lose your benefit. When you get into the private sector, that's true if you work for a company who's sure to survive. So if you're working for a company, it's still profitable, maybe not as profitable as it would like to be, but nobody's questioning its survival here. It's just like the public sector. They'll have to pay more for their pension. They'll get through it. But if you're at a company that might go bankrupt, the plan goes under without sufficient assets, the employer doesn't have the money, and you lose benefits.
Well, let's talk about what happens when a company is restructured, purchased, or worst case, bankrupt. What happens to the pension plan?
Restructured and purchased aren't really problems. The restructured company will have the pension plan, or the acquirer will acquire the pension plan along with the business, and it will motor on much as it did before. The troubling one is bankruptcy, because in bankruptcy the plan winds up. If it has sufficient assets, that's fine. You get your benefit, everybody fights over the surplus. But if it doesn't have sufficient assets, usually in theory the company is to make up the shortfall, but usually in a bankruptcy the company doesn't have the money.
So what happens to the workers in that case?
In that case, typically there will be a partial loss of benefit. It's not all or nothing. It's not a matter of it didn't have enough assets so you don't get any of your pension. But you might get 80 or 90 cents on the dollar instead of 100 cents on the dollar.
How confident can the young workers be that the pension will be around? Let's say the company's in bankruptcy and the pension plan is, I guess it's sort of frozen. And how the young workers who've only been contributing for a little while, how confident can they be that 40 years down the road, this same pension plan from this same bankrupt company is going to be able to pay them benefits?
Well, that's hard to say. It's as a rule you can't see in the private sector 40 years ahead. There were nobody 40 years ago would have thought General Motors would be in trouble, or the CBC, right, or any of these other organizations. So you can't see 40 years. What you have to hope for and trust in is that the laws of the land that require pension promises be funded will provide you with sufficient protection. Right now, as I said earlier, that doesn't guarantee you get your whole benefit, but most people are going to get most of their benefits.
Okay, last question for you, Malcolm. Young workers, generally speaking, how confident can they be in company pension plans right now? Because I'm starting to hear a lot of young workers say, well, I don't really see that as being something that I'll be tapping into 40 years down the road. I think it's all up to me. Is it all up to them, or can those company pension plans be relied upon?
Well, I think you can rely on them to deliver the benefits that you earn. You can't necessarily rely on the company to be there for 40 years, but you can rely on getting something out of the pension plan at the end of the day. One of the problems we have now, though, is increasingly private sector workers aren't in pension plans because employers are deciding, just as the employees are losing confidence in pension plans, employers are deciding it's not terribly opportune to offer them.
Okay, so I think there's one key message here. That's pension plans can survive companies that may come and go.
Yes, they do.
Okay.
They do.
Great. Thanks, Malcolm.